Joining me now, editor of Grant's Interest Rate Observer, Jim Grant. Jim, your Twitter handle is Grant's Pub. So reading your notes, I'm figuring, okay, I might need a couple of shots before this interview is over because, like the U.S. Postal Service, you're saying Jay Powell is determined to deliver through rain, sleet, snow, recession, no recession, banking collapse, no banking collapse. The Fed is going after that target no matter what.
Yes, he is tightening into a credit contraction, which is kind of a new thing in the annals of central banking, but I guess not unheard of, but unusual.
Well, didn't Jean-Claude Trichet do something similar to that, and many people considered it a mistake?
I forget now what the inflation level was when Mr.
It wasn't probably as high as this, but he was hiking into a recession.
The Europeans have even less tolerance of that than Americans do.
So then, you know, we look at certain things. For instance, consumer sentiment polls are really ugly. I don't care which one you use, and not just current conditions, but what people expect in 6 months. Does the Fed consider any of that stuff, or do they just stick with the numbers, just the data itself, and not some of the sentiment stuff?
Well, the Fed doesn't share its magic sauce with me, but I suspect that the Fed is essentially model-driven. It takes a little bit of this, a little bit of that. It has its dynamic, stochastic, general equilibrium models, which
but I do hear them say, you know, we spoke to our contacts in the business area.
They have a beige book. They mean to be the ubiquitous and omnivorous consumers of data. I think what they need, perhaps, is a greater conceptual awareness rather than a statistical one.
What does that mean?
That means that they ought to be aware that they are unaware. For example, they did not twig onto the oncoming mortgage crisis until about 6 weeks after it arrived. They persisted in this storyline of a transitory inflation. The Department of Common Sense is the only bureaucracy left to open in the Fed that would not be redundant.
You know, it's interesting as you say that. One of my problems, and listen, I just kind of read this stuff and study it, but the data that is always looking backwards. We know that, right? But some of it just seems so spotty. You know, the JOLTS report. You know, the folks who take the survey now down to maybe like 30%. It just doesn't seem like a reliable, like what they're looking at in terms of the X's and O's are just reliable enough to be making these decisions that changes everyone's lives.
Yeah. Well, it goes without saying that the data are always mixed.
Right.
There's always, but you know, I think that there are a lot of signs of impending trouble. We have a collapse in the rate of growth of money. We have an inverted yield curve, meaning short rates are punitively higher than long ones. And we have weakening commodity prices, even the things that are not speculatively traded. There's something called the CRB, spot raw index, which is something like tallow, and that is very weak. So I think that the burden of evidence to me is on a weakening situation, which burden is increased by the now newfound caution, if not fear, of commercial bank lenders.
Yeah, where would you rank that? I remember in early 2009, the word on Wall Street was the next shoe to drop would be commercial real estate, and you know, so stay away. And a lot of people actually missed the bottom of the market because they were anticipating that. But it's hard not to see. I mean, we saw Nordstrom's pulling all their stores out of San Francisco, already a 30% vacancy rate. Is that a big enough? Economic area to trigger a bigger fall in the overall economy?
Well, it's part of the mosaic.
Okay.
And I would say that the private credit is another piece of that mosaic. The bank credit is still another piece. And when you look at these pieces in ensemble, you are looking at a little spot of trouble.
Before I let you go, Elizabeth Warren wrote a letter to Jay Powell a couple of days ago. And I'm reminded of what I've read from Arthur Burns, who was the chairman of the Fed from 1970 to 78, who's known for stopping, stopped hiking rates. And, you know, he's considered, no one wants to be Arthur Burns, but he said he had so much political pressure back then, he had no choice. Any chance at all that political pressure can sway the Fed right now?
I don't think so. I think the Fed is now driven by institutional embarrassment as much as anything else. I think they are mortified at this inflation, and they are going to persist. They are going to be Volcker and not Burns. But in the course of that reaction, they are tightening into a credit contraction.
So if Jay Powell can get a round of applause every time he walks into the country club, he's done his job well.
I think that he likes to look at himself in the mirror and say, that's Volcker.
Yeah. Jim, you are absolutely the best. James Grant, your interest rate observer, is a must-have on Wall Street. We appreciate it. Thank you very much.